So what if you could find a mutual fund that acts like a high-growth small-cap fund when the market's hot, and then switches to a safe, stable large-cap fund when things get shaky? Well, that's exactly the promise of a Flexi-Cap fund. But you know what? That's also its biggest danger. Today, we're going to give you a framework to cut through the noise and figure out how to pick the right one for you.
All right, so here's how we're going to break it all down. First, we'll talk about what makes these funds so special, their freedom and the danger that comes with it. Then we're going to get into the really sticky stuff, ethics, with a real-world example you have to see. From there, we'll build a framework based on trust, and I'll show you a fund that actually fits it. We'll even tackle the tough questions people are asking about it right now. And finally, we'll wrap it all up with a look at the bigger picture. Okay, let's kick things off with Section 1. Let's really get to the heart of what a Flexi-Cap fund is all about, and the incredible freedom and potential danger they represent.
So just think of a Flexi-Cap fund manager like a five-star chef who has access to any ingredient they could possibly want. They can go for the tried and true prime cuts, those are your big large cap stocks, or they can get creative with some really exotic high-growth ingredients, your small caps. The point is, they have total freedom to cook up whatever they think will be the best meal for the current environment.
And this is what's so cool about them. They're like chameleons. When the market is booming, they can shift their colors to look like an aggressive mid and small cap fund, really going after growth. But the moment the storm clouds gather, poof, they can change again, becoming a defensive large cap fund to protect your capital. It's an incredible advantage.
But here's the catch. With all that power, with all that freedom, comes a massive risk. Is that freedom going to be a reward for you, the investor, or is it a danger? Well, that all comes down to the people behind the curtain. The fund house's ethics, their morals, and the fund manager's personal discipline. That's it. That's the whole game.
All right, Section 2. Let's talk about those ethics, because honestly, this isn't just some fuzzy, feel-good concept. When it comes to your money, it's everything.
And to show you what I mean, let's not talk in hypotheticals. Let's look at a real-world case study, the Lenskart IPO. This one incident tells you so much about how different fund houses operate.
So when Lenskart went public, a whole bunch of mutual funds wanted in on the action. In fact, a total of 21 different funds jumped in as anchor investors, to get that early piece of the pie. But here's where it gets weird. Some of these funds invested a tiny, almost laughable amount of their total money. We're talking as little as 0.1% of their assets.
I mean, come on, let's be real. If you truly believed a company was the next big thing, would you invest just a fraction of a percent of your money in it? No way. An investment that small basically screams, yeah, we're not that interested, but we're showing up for other reasons. It's not a high conviction idea, not even close.
So you got to ask yourself, what's really going on here? Are they making this tiny investment to make you money? Or are they just trying to keep their PR agency happy? Or maybe, just maybe, their parent company's investment banking division gets a little something out of it. Is it about creating value or just creating hype? These are huge red flags.
Which brings us to Section 3. Given all that potential for conflicts of interest, how in the world do you find a fund that you can actually trust? Well, you need a framework. And our framework is super simple, but it's powerful. It's built on just 3 things. Number 1, top-notch ethics, no question marks. Number 2, structural independence, meaning they aren't part of some giant company with a million other priorities. And number 3, a proven track record of intelligence and, most importantly, discipline. These are the non-negotiables.
Now, when we apply this filter, when we look for a fund that checks all 3 of those boxes, year after year for the last 8 years, one name keeps coming to the top for us, the Parag Parikh Flexi-Cap Fund.
So why does this one fit? Well, for starters, it's true to its label. They do what they say they're going to do. The leadership team has been incredibly stable. They have a disciplined, long-term approach, and they're not constantly chasing the latest hot trend. In fact, they've had their flagship fund for 13 years and haven't messed with the formula. It's a true boutique firm focused on one thing and one thing only.
Okay, moving on to Section 4. Look, no fund is perfect, and a good analysis means playing devil's advocate. So let's tackle the 2 biggest knocks, the 2 biggest concerns that people have about this fund right now.
The first one is probably the most common question I hear. Hey, the returns have been good, but they haven't been great lately. They're not outperforming by a huge margin like they used to. So what's up with that?
Well, the main reason has nothing to do with the fund manager and everything to do with regulation. See, one of their big secrets was investing in amazing U.S. tech stocks. At its peak, that was about 30% of their portfolio. But then the RBI stepped in and blocked fresh investments overseas. So as the fund got bigger, that crucial foreign part got diluted all the way down to just 13%. That's a huge change.
And the second big question is a classic problem for any successful fund. It's gotten really big, right? The assets under management, or AUM, have ballooned. So the question is, has it gotten too big to be nimble? Too big to be effective?
For most funds, that would be a real concern. But remember what we said about Flexi-Caps? They can invest anywhere. A small-cap fund is like a little fishing boat stuck in a small bay, but a Flexi-Cap fund is like a supertanker that can roam the entire global ocean. What seems huge is actually just a drop in the bucket compared to the whole market, so there's still plenty of room to maneuver.
All right, let's wrap this up with our final section. It's time to zoom out, look at the big picture, and understand why we're sticking with our approach despite the recent noise. The way I see it, this fund is like a legendary athlete, a Sachin or a Virat. They've set the bar so incredibly high for so long that when they have a perfectly average season, everyone starts to panic. But does that mean they're a bad player all of a sudden? Absolutely not. You still bet on the champion, especially when their core process and principles haven't changed one bit.
So at the end of the day, it really comes down to this one question for you. When you invest your hard-earned money, what are you going to prioritize? Are you chasing the hot, short-term numbers, or are you investing in long-term principles you can trust? The answer to that question will pretty much define your entire journey as an investor.